We have Lee Munson, Chief Investment Officer at Portfolio Asset Management, Joe Battipaglia, Market Strategist, Stifel Nicholas, and Rich Ilczyszyn. My God, I rehearsed that so much, Rich. I hope it's close. He is the Senior Market Strategist at Lynn Walduck, a very fine firm. Welcome to the show. Rich I is how we're going to talk to you. Rich I, let me go to this. Stronger growth, stronger dollar puts a lid on commodity speculation. Now, we'll get to the stocks in a minute, but I want to start there. Do you buy that hypothesis?
Absolutely not. I think this is a correction. I agree with a lot of what you began the show with. The thing I have to say is you're going to see a divergence between the dollar and commodities at some point. Now, let's backtrack for the last couple of months. We've had banner returns in commodities. Why can't the commodity guys take a little off the table up here? This is a corrective pullback. I don't think the top is in by a long shot. In fact, if you take a look at some sectors like grains, we're still off 20 to 30% from highs from just 2 years ago, and I think if you get supply concerns, there's still going to be some upside potential there.
All right, but you fell into that poorly baited trap beautifully, Rich. Welcome to the show. Because 2 years ago, when you're talking about 2 years ago, that was really 2008. That was the dollar crack up, the dollar collapse, $150 oil scenario. That was the deep recession. What I'm saying now, Joe B., let me go to you. I don't see a deep recession, and you and I probably disagree a little bit about the American economy, but I want to throw one more thing in. Besides strong growth in the U.S. leading to a better dollar, China's manufacturing index fell for the first time in 5 months, Joe. Now, that is enough to knock commodities down, too. So China's going lower, perhaps. The U.S. is going higher. How do you see the commodity play? Will today's correction continue tomorrow?
Well, timing is everything, and for the Chinese to try to tamp down on inflation, curb some of the growth, which would mean that the demand for raw materials slows to some degree, still expanding, but certainly not at the record pace of the previous couple of years. Add to that the Eurozone, which is having its own problems with growth outside of Germany, and the U.S. on the mend. What you've got in combination is a very good, I think, supply and demand position in 2011, which could take pressure off these commodity prices from going higher. And in the ag complex, American farmers don't need to be told twice that things have been good. They'll be planting aggressively. So it wouldn't surprise me that these commodity prices actually pull back a bit further in the course of the year, which actually reinforces growth, because higher energy prices here in the U.S., frankly, is a massive tax on the consumer.
Absolutely. I think you nailed it on every point. I want to get Lee Munson to weigh in, because not only U.S. going up, China going down a little bit, Europe soft, as Joe B. said, probably right outside of Germany, for heaven's sakes. Let's not forget, Lee, one of your heroes, President Obama, he's acting more and more like a pro-business supply sider, right? He's going to overhaul the corporate tax code. He's going to overhaul the individual tax code. He sounds like, I don't know, not exactly Ronald Reagan, but there are faint hinges. That is a pro-growth. So therefore, a strong dollar, weak commodities. Lee, what do you make of this?
I think that you can have a strong dollar and strong commodities. I don't buy this total slowdown in China. I think that Joe's right about the slowdown in Europe in general. But let's break this down a little bit. While I wouldn't touch copper right now, I'm out here in the Wild West in New Mexico, and I got an 8-gauge double barrel loaded today, backed up the truck on oil and gold. And I'll tell you why. Oil is something the industrialized and the emerging markets need the most of. I'm not really concerned about a tax hike because of energy. Listen, we got happy Republicans, we got QE2, and people who make some money got $300 billion in tax cuts just a few weeks ago. So I'm kind of a happy guy right now. So I would say use this opportunity, this little blow off, to start building up. I think the dollar can go higher, but remember, we're still spending too much money.
Commodities are priced in dollars, Lee. This is one of these tautological facts of life.
Wait, Larry, gold is. Let's have a little step back.
Yes.
Gold is the only commodity that's priced in every single currency. Now, you can make that case with copper. Hey, I think if you want your bear claw out, short some copper. But even though oil is priced in dollars, we're going to have this industrial demand for oil. I do not think it's priced in yet. I think oil has been suppressed. I think that once you start getting auto sales up, once you start getting these commodities rolling again, the U.S. can make that energy cost go higher. People start feeling rich. They're not going to be thinking about energy savings at that point.
Right.
And I disagree with you totally on gold. I think you're wrong. Gold is priced in every single currency. Emerging markets want it because they want to hide it from their governments.
Gold is a special
happened in Hungary. They just stole people's pensions.
We're going to talk about gold in a few moments, and I have a different hypothesis on gold. But let me go back to our guest, Rich. Rich, there's a big story on the front page of Investors Business Daily about oil. Now, I want to bring in oil got nailed today, too. So it's dropped down to what? It's below $90 now. And I know oil's been very worrisome, and I appreciate that fact. But here's the thing about the Investors Business Daily story. It cites a whole bunch of countries that don't want $100 or $120 barrel of oil because that would wreck the world economy, and there was damage their revenues. Saudi Arabia, Iraq, Nigeria, Angola. An earlier article in the Wall Street Journal, a week, 10 days ago, maybe 2 weeks ago, talked about the big oil companies investing $500 billion, right, for all facets of oil exploration, discovery, production, and lifting. Now, to me, that says that the oil supplies are going to be expanding, and that, too, will put a lid on the oil price, and we will avert the disaster scenario.
You're talking about 10 years from now as far as exploration, so we'll address that in 10 years. Right now, you've got to take a look at energies across the board, from gasoline prices being at this level this time of year, natural gas, and crude oil. Listen, if you bought oil in the beginning part of the year, I'll give you this. You probably didn't make any money. You sat with it all year. The market never took off. I think this is going to be an energy year based on demand. You know, we got the numbers this afternoon from IPA. We got a draw of 7 million barrels of oil. We're finding support again. I'm not suggesting you buy oil now.
Slack.
I'm looking for $110 the first quarter, irregardless of the dollar and the equity market.
Right,
and I don't think anything's going to stop it.
I won't argue
point.
The first quarter.
And Larry, you actually believe that the Saudis are telling the truth.
This 10-year investment horizon is not true. The slack in Saudi Arabia, slack in Angola.
But you see my point,
Let's talk about Iraq. In other words, they can add 10% to the supply of oil right away in order, and in fact, it wouldn't surprise me if they are already doing that, because it is not in the OPEC self-interest, Rich. It is not in their self-interest to have your forecast come true, which might drive gasoline prices to $3.50 or $4 and damage the whole economy. Joe B., weigh in on the way out. What do you make of this? The OPEC idea that they're going to add oil to hold. They don't want $50 oil, Joe, but the paper said $70 to $80 sounds reasonable to me. What do you think?
Well, they saw the extremes. At 140, the economies collapsed on themselves. The oil price got down to the 30s. That was not a sustainable price. They would like to see a stable, even flow across all economies to keep this ball rolling. So somewhere north of, let's say, 60 to 90, somewhere range like that, is where they like to keep it. Beyond that, it becomes very problematic for them. And I think the demand and supply condition is favorable to the consumer right now in terms of oil availability, resource availability, and the speculative excess driven by a falling dollar falls by the wayside in this scenario. And that's a good thing.
All right,
so
Joe,
why is it at $92
you guys suggest
guys?
that OPEC can actually control something. They haven't been able to control anything since the mid-80s, 70s.
No, but what they do is they put more supply. More supply comes in the market at the higher price.
They don't have any more supply. They're lying about what their reserves are. We're past the peak. I mean,
we can make the same claim about the Chinese and their growth rate, but the fact of the matter is the demand curve has been much smoother than it has been in the past. Right. Europe is slacking a bit. China is trying to decelerate to a degree, and inventory is pretty high. So I think you can get a lower price.
88 million barrels a day.
Then you better hope there's going to be peace in the Middle East, or we're not on the eve of war.
Lee Munson, you got to do some homework on this. 88 million barrels a day. That's the International Energy Agency. That's all it is. Up 1.5% from a year ago. OPEC could easily add 10% just like that. They're running spare capacity right now, for heaven's sakes. I don't know. You oil bulls, you commodity bulls, gentlemen, stay with me. We're going to come back because we have not concluded this yet. And we're going to try to translate some of this commodity discussion into a stock market discussion.